Good morning, this is Kim, and I'm going to spend some time going over the sample quizzes that I gave you in your weekly folder. So let's get started in preparation for your quiz 3. Also, by the way, I want to mention halfway through the class right now, so it's really important that you stay with me. We have some exciting things coming up, particularly next week when we start talking about mutual funds and exchange traded funds, which are really important for you. Okay, moving on. First quiz question. Define. So define means just that. When I ask you to define it, you can't just list it. That won't be correct. So I've already typed them out and I'll define them for you. Blue chip stock, remember, has a history of price appreciation and growing divs. Income stocks. Income stocks, not blue chip, but really we're looking for that that growing dividend. So people buy these for the dividend, not so much for price appreciation, but because they're going to pay out this steady dividend forever. And really, if an income stock stops paying a dividend, it would be a huge sign that the company is in significant trouble. So a lot of these are owned by people who want to own stock, but they don't want the risk of growth stock, for example, and maybe they're relying on that dividend for part of their income. Growth, kind of the opposite of income stocks. We're looking for price appreciation here. That is our big deal. We want to enjoy or share in the growth of a company and what they're doing. So, again, more risky. A lot of growth stocks are newer companies, small cap, mid cap, etc. Cyclical stocks. So, these are going to be tied to the economy. Housing stocks, auto stocks, things. If consumer confidence is really high, then more people will shop at Whole Foods, for example. More people will buy luxury type items, go on trips, etc. And when the economy contracts, it's just the opposite. Then people will start going to budget department stores, and anyway, they change their buying patterns. So those are cyclical stocks. And lastly, penny stocks, to me, in my opinion, are gambling. So that's all I'm going to say about that. Okay, what are the three differences between three? I asked for three. Well, here's differences. Ratings, the call feature, risk, and tax status. Again, AAA rated for government bonds. Call feature, government are all non-callable. I'm talking about federal government here. Risk, government bonds are generally safer because the United States federal government is always going to pay its bills. uh, Now, that's not the same for some of the munis and state bonds, which are rated. Again, rated bonds have a different level of safety, very similar to corporates. And lastly, tax status. Well, we know that we can enjoy some tax status. Federal bonds are locally tax free, and then munis are federally tax exempt and state tax exempt if you buy them in your state. Okay, this is the big question. You're going to have one like this on your test, so just expect it. It'll be a 10-point question. I'm going to ask you to evaluate two stocks. So I'm going to say now that right up front that if Yahoo's giving you problems, you can always go to Morningstar. So in here, I'm at morningstar.com. Practice with this first. Okay, if Yahoo's not working for you, or bounce back and forth and have both browsers open. So I asked you in this one to evaluate Procter & Gamble and Johnson & Johnson on 6 factors discussed in class. Now, here's a disclaimer. These are only fundamental factors that I'm asking you to evaluate. If I, Kim, were to consider purchasing an individual stock, I'm going to stretch beyond fundamental factors. I'm really going to look for the qualitative component of the stock. What's going on with this company? Are they coming out with new products? Is it a product that I feel is going to be successful in the market? Where's their competitive standing? How's their leadership? Is this a really solid company that's going to make me money? Because again, individual stock purchase is more risky than if you bought the index, for example, the S&P 500, and you got to beat it. Okay, over a long period of time, you got to make money on these individual stocks, and it's not a dart throw. And there's lots of camps that say it's really difficult to pick the winners of individual stocks all the time, and people say, oh yeah, I have friends who always beat the market, and well, you know what, maybe they do, or maybe that's just a lot of hype. Anyway, so it's this is one component. It's not the only component, but that's what we're using for this class. So Procter and Gamble. Again, I'm in Morningstar right now, uh, looking things up, but I already did this one. It's $5.44, and now what I'm going to do is I'm actually going to go in Morningstar over here, and I'm going to type in Johnson and Johnson, which is J&J, again traded on the New York Stock Exchange, and here I go. Please practice this at home before you take your quiz. So here's Johnson and Johnson. Price doesn't matter. I mean, price isn't a factor. Just want to remind you of that. It's not a factor. You can still you make money on whatever price you pay. So that's not the defining analysis feature. Yeah, I'm going to go over here right now to key ratios. Let's see what's going on. And well, right here in the key ratios, I have my revenue, and I know that at least for me, I'm really interested in growing companies. So I'm going to look right here, and this is from 27, 28, 29. So it's in order of year, and it has a lot of years, even more than Yahoo. And what I can see is, we're up, we're up, we're up, we're up, we're up, we're down a little bit, and then we're back up, and it looks like we're more on an upward trend. So there's a little bit of inconsistency here in 2015, but generally the trend is up. So I'm going to go over here and I'm going to note, okay, for Johnson and Johnson, the trend is generally up. But I will tell you, if you looked at Procter and Gamble, you would see declining revenue growth. Well, what's that? What's that about? And in fact, Procter and Gamble has been struggling with declining revenue growth. So this is more positive to me than a company that is in contraction, despite the fact that they might be making money. All right. So I'm going to go over here now to what do I have? Dividends. Here's my dividends. So my latest dividend for Procter & Gamble, I'm going to see if I can move this over a little bit. Dividend for Procter & Gamble is $3.20, or for Johnson & Johnson, I'm sorry. So I'm going to go here and I'm going to click on $3.20. So it's not as much earnings as Procter & Gamble. And my dividend, I'm looking for I just did that wrong. Earnings per share, sorry guys, $5.95. Div, $3.20. I don't have my dividend yield here, I don't believe. Let me go see. Do not. So I'd have to calculate my div divided by my price. Or I can go look it up on Yahoo too. Chart 52 week. So what has been the 52 week change? I'm going to pop back in here for J&J for you guys because again, you can pick and use whatever's more comfortable, but this I know you know. Okay, so dividend yield, again, is going to be on my summary page. It's also going to be down here on the bottom. So I have trailing annual dividend of $3 and oh, here's my dividend yield, which is 2.54%. So that's the dividend expressed as a percent. And then again, going back to statistics, my 52-week change for Johnson & Johnson was 7.82%. Look at the S&P 52-week change, 13.48. So for this year, Johnson & Johnson has not beat the S&P 500. But again, we want to look at that over time, not just a one-time period. Okay, return on equity. Again, management effectiveness right here. So return on equity for Johnson & Johnson is 23%. Historical dividends, I know there's been growth over time, so that's going to be the same. PE, what is the PE ratio here? Trailing PE is 22, so it's a bit higher than Procter & Gamble. Again, PE, we want low. We really want low PE. Debt to cash. So this is something that's really important to me. I think companies have more opportunities when they're not carrying as much debt. So for Procter & Gamble, they had $30 billion worth of debt and $14 billion worth of cash. And over here for Johnson & Johnson, their total debt, again, about the same, 32 billion again. And their cash is about more, 39. So they are in a better position than Procter & Gamble. What's the beta? So I'm going to go up here for beta, which I know is at the top. Neither one of these companies have a lot of market risk, and the reason is because they make so many products that we buy in good times and in bad. They're just not. They're more on the stable end, just not very risky. Not very risky stocks. Okay, and this next thing I want to show you is let's look and see if it beat the S&P over time. So I'm going to pop back in here to Morningstar for Johnson & Johnson. I'm going to click on performance because Procter & Gamble did not. So here I am at Johnson & Johnson and I'm on performance and I'm going to just scroll down here and I want to look at total return here over time. So here's Johnson & Johnson, here's drug manufacturers, and here's the S&P 500 all in a row. But it's clearly illustrated by a chart. So we have Johnson & Johnson in blue, all drug manufacturers in general in orange, and the S&P in green. So I'm looking on over time and I see that year to date Johnson & Johnson is winning. Here, kind of the 1 year S&P. Here, kind of neck and neck with the S&P. Johnson & Johnson wins, Johnson & Johnson wins, and Johnson & Johnson wins. So yes, Johnson & Johnson has been beating the S&P, which is a good thing. Let me show you what it looks like for Procter & Gamble. Again, PG, Procter & Gamble. Going back again to total return. Again, same thing. PG is blue, S&P is green. Look at this. Does not, does not, does not, does not, does not, does not. Okay, so really does it make sense to own a stock that has not ever beat the S&P 500? One stock versus 500 stocks in an index. It's just something I want you to think about. So over here, again, did it beat the S&P? Yes. So without any qualitative analysis on our part, look at what we have here. EPS, Johnson & Johnson, higher. Div, Johnson & Johnson, higher. Dividend yield, lower because Johnson & Johnson's price is higher. Chart, 52-week change, again, higher. ROE, again, both of these. Revenue growth, up. ROE, up. Both have growth over time, that's an equal. PE, again, we want low. Debt to cash, hands down, Johnson & Johnson. Beta, these are too close. I mean, too close and very low risk. Beat the S&P, yes. So on a fundamental analysis based on 6 factors, I'm going to say Johnson & Johnson at this point represents the better investment because it beats Procter & Gamble in almost every fundamental that I reviewed. Okay? That's what I'm going to say. I'm going to write some narrative down here as, it's J&J because of higher, you could say all of them. Higher revenue, higher EPS, growth, etc. Okay? Give me a reason why you're going to pick one. This one was painfully obvious, but perhaps the one on your test won't be as obvious. Okay, I'm going on. You're always going to have one of these kinds of questions. You purchased a corporate bond 3 years ago that pays 6%. 6%. Purchase price was $1,000. 3 years after your investment, comparable bonds are paying 8%. Okay, think about this. Just stop here before you even solve it. Interest rates went up. So what's going to happen to the value of the bond? It's going to go down. There is an inverse relationship. Inverse relationship. And you should always have this formula. So current price equals, how about equals here? Coupon of your bond, coupon payment, divided by current rate. Same formula, current rate equals coupon payment divided by the current price. Okay, all I did was switch around the numerator or the denominator over here and moved it to this side. It's the same math equation. Okay, what is the annual dollar amount of interest that you receive for your bond? Remember, this equation is always coupon payment, coupon percent, I guess, multiplied times par value. What is par value always? It's always $1,000. So in this case, let me back up here. It's going to be, my coupon payment is 6%, 0.06 times $1,000, which equals $60. Next, again, interest rates went up. Use that equation I just gave you. And the equation says that the current price equals the coupon payment, well, $60 divided by the current rate, 0.08. That's the current rate. So if I put in my calculator, $60, enter, 0.08 divided by, it equals $750. There you go. Okay, I like these kind of questions too. Alan purchased 100 shares of Disney stock at $60 a share. 1 year later, she sold the stock for $58 a share. She paid her broker a $50 fee when she bought and $50 when she sold. During the year she owned the stock, she received $170 in dividends. Calculate the total return on this. So I think the easiest way is to go income, costs. So income, first of all, when she sold it, she received $58 times 100 shares, which equals $5,800. Next, income. She received a dividend of $170. $170 in dividend. Okay? That's all. No more income. Now costs. She paid $60. So 60 times 100 shares equals $6,000. She also had to pay ridiculous amount of broker fees. 2 times $100. So she has $100 in broker fees. So let's add these up. 5,800 plus 170 equals 5,970 income, and then our costs are 6,100. So I have, oops, let me just do this consistently. So I have 6,000 plus 100 equals 6,100. So her costs are higher than her income, right? These are costs. So she didn't make any money on this. So 6,100 subtract 5,970 equals $130 loss. Now, on your problem, you're probably going to have to look up the price for a year ago. And again, not that hard. You can go to, you can use finance.yahoo. Again, you need to be careful with this and make sure you do it right. You're going to look up historical data. Or maybe not. And then the time period, you could say July, I already did this. Make sure you change the time period and click apply. Okay? So, like for Johnson & Johnson, you could also just put in 1 day. So you could say, hey, I want to know start to end date 1 year ago. So I can put 7/10/2016 in both of these and hit apply. And of course the market was closed a year ago, but I will not give you a date that was a year ago that isn't applicable. So let me look on the 8th, or the last closing price. I'll look on the 8th and I'll hit apply. Wasn't open on the 8th. Oh, there we go. And I will tell you, usually I have you use the closing price, so there would be the closing price 1 year ago. Make sure you know how to do that. Okay, this question you can skip because the web page isn't working anymore. Describe the terms market order, limit order, and stop loss. Again, market order is just buying a stock at the current market price. A limit order is when you put parameters on it. As I mentioned in the video for the week, you say sell my stock if it hits $100, or anyway, you're just putting a limit on it. And then stop loss is what we can set. And actually, I've actually been using stop losses for some of my clients. I'm putting in a permanent stop loss because the market is so overheated right now, and I have some clients who are older and retired, and I'm enjoying all the gain, but I don't want the downside risk. So I'm putting in a stop loss that says anytime it reduces maybe 5 to 10% below the new high, go ahead and automatically sell it. So my plan there is I'm going to lock in some gain. I'm not going to ride the market back down. Okay, number 8, long-term investment strategies. You need to know these. Buy and hold, just what it says. You're going to buy good companies and hold them forever. Direct investment is you buy directly from a company, and I'm going to just note here that it's complicated. and frustrating, and I don't do it because of that. Dividend reinvestment is just what it says. Anytime your stock pays a dividend, you take the dividend, turn it around, and buy more shares of the stock. And lastly, dollar cost averaging. And that is where you take a fixed amount of money each month and invest in a the same asset over and over. And the idea there being that as long as the market continues to go up over time, your average cost will be less than your average revenue and you will make money. 9, the 3 stock market indexes. You should know these. They are the Dow. They are the S&P. How about S&P? And what's the other one? The NASDAQ. Okay, you'll be able to look up today's numbers, which you should be able to do. They're going to be posted on any major website. Now, why do we care? Who cares about the stock market indexes? Well, we care about them because they give us an indication of how the overall market is doing over time. And maybe if we get a feel for what's happening in our own portfolios. Certainly they alert us if anything major is going on, but I hope you recognize this. We do not panic over the noise in the stock market on a day-to-day basis. Okay, my goodness, I'm already 26 minutes into this, so I'm just going to go over to this other test that I had for you and see if there's anything. How do we make money in stocks? You should know this. Price appreciation and dividends, bonds, price appreciation and interest. Cash equivalents, interest only. We already did one like that. We already did the factors and we already did this. And in this one, see, I asked you for Costco a year ago. And you're going to have to look up the historical price. So just make sure you know how to do this. Although you're studying individual stocks and bonds, why they are unsuitable for you at this time. A, you don't have enough money and you don't buy one stock. It's just too much risk. Next, you really need a more comprehensive analysis. Again, it's not just fundamentals, but that more qualitative assessment is a reason not to do it. Bonds, you need $10,000 just to enter the market. So there's all kinds of reasons. You want to become an individual investor, take the next class, which is 325. Why does dollar cost averaging work? Just explain that. As long as the market increases over time and you dollar cost average, you can make money. Why do we care about the indexes? Again, they give us an indication of how our portfolios are doing. Okay, this was longer than I expected. I hope you listened to it and you're ready to roll. Thanks and have a great day.